Let's shift focus now to the EMS space, where there's been quite a bit of action as well. And this is on the back of the Q3 performance, the latest focus that we've had on them, of course, and the guidance numbers. Before we speak with Renu Baid of IIFL Capital, Puneet is here to set things up, to tell you about the key numbers that you should focus on. Puneet?
Well, thank you for that. It's clear as night and day in terms of the winners and the losers, especially in the EMS space in Q3 for Dixon and Kaynes. And this is on revenue growth estimates. What was the estimate or consensus estimates by analysts, as well as what was the actual delivery. So just a 2% growth for Dixon Tech versus a 17% growth. So for Dixon and for Kaynes Tech, there's been a big miss in Q3 versus estimates. Kaynes, speaking to NDTV Profit, did mention that they are expecting a lot of that recovery happening in Q4. There's still a guidance cut, and we'll get to that in just a bit. But for the other three players, Amber Enterprises, PG Electroplast, and Syrma, there's been a consistent beat. For Amber, a big one, when the industry estimates for ACs were expected to be a weak quarter. An 18% estimate for Amber has resulted in an actual growth of 38% in terms of revenue. For Syrma and PG Electroplast, also a big beat is seen in this particular quarter. But let's break it down by these players. What led to the Dixon and Kaynes reporting weak results? Specifically for Kaynes, the guidance cut was one of the weakest aspects with a revenue growth of just 22%, as we highlighted in the previous screen. The company now expects revenue growth at 4,100 crores for this year versus the earlier estimates of 4,500 crores. And Dixon Tech, the biggest talking point was the company not receiving the JV approval for Vivo yet. And Vivo individually roughly forms 30% of the company's overall volumes for FY27. So out of the 65 million smartphones they are expected to make and sell, almost 20 million is individually for Vivo JV itself. So that was a clear negative in this particular result. For Syrma, Amber, and PG Electroplast, a broad-based growth is what we've seen. Syrma's margins at 12.61% were the highest since 2022 when the company listed. While they have maintained a 5,000 crore revenue target for FY26, that would imply a growth of almost 34% for Syrma SGS. For Amber Enterprises, they are expecting a growth of 15% this year versus an industry growth of 0%, flat industry growth for the AC space. They are expected to outperform is what the management guidance is. They are also, for PG Electroplast, they maintain the guidance of 5,700 crores in terms of revenue for FY26. But finally, in terms of valuations, and that's the last plate we want to talk about, because we've seen consistent, FY25, 27 valuation largely, inch up after the FTAs of EU and, of US. So you've seen some increase for both Dixon Tech as well as Amber Enterprises. But the three companies that have actually done well in Q3 still trade below the market leaders, while Kaynes have had their own set of issues. So that's largely the picture for EMS in Q3. Clear winners there, but a lot of focus on the future for FY27 and 28 lies ahead.
Thank you for that, Puneet. Renu Baid Pugalia, Senior Vice President Research at IIFL Capital, joining in. Renu, thank you so much for your time with us this morning. It seems like a very exciting story on the EMS space is sort of losing its sheen. Do you see this as a temporary hitch that we've seen this quarter because of a whole host of reasons, and Puneet has laid them out in great detail? Or is the best behind them in terms of the first flush moved by PLI?
Well, hi, good morning. I think EMS space of companies were expected to show slightly mixed performance this quarter. Some of the headwinds that individual companies were facing were broadly known. For example, in case of Dixon, since last couple of months, it was known that given the sharp inflationary impact on the memory chip prices, smartphones market has been weak, and that would result in a relatively softer quarter for Dixon, and which is where the numbers were. And just want to correct that Puneet did mention that X of Vivo volumes in 27 forecast. So Vivo overall annual volumes are 20 million, but the JV share would just be about 10 million. So even from the management guidance of 60-65 million unit handset, which will knock off 10 million, X of Vivo JV, they're still guiding for volumes to be reasonably healthy at 50-55 million versus a 34-35 million, which is expected in fiscal 26. So there's still about a 30-40% jump, which is expected on the mobile handset, despite market being fairly weak in the current calendar year. Coming to broad EMS sector, it's been a mix and a transient impact. Some of the government-facing customers have had delays in offtake and payment issues. So companies like Kaynes had gone slow in terms of their deliveries for Kavach. Rather than keeping the working capital bloated, they have deferred a bit of their deliveries there, and which has partially impacted the revenue guidance also. In case of Syrma, yes, they've delivered well. The revenue mix this quarter was reasonably favorable for healthy mix coming in from industrial and other segments. High margin orders were executed, and where I think company consistently for the last 3 to 4 quarters have been beating on their own margin expectations and guidance, and revenues have been broadly steady. So which is where we have seen gradual re-rating happening for Syrma over the last 1 year. For Dixon, yes, the overhang on the uncertainty or the timing of the Vivo approval has played a major role in terms of valuations taking a bit of knock. And the growth outlook for the smartphone segment, especially the economy segment, the mass market, where Dixon has a reasonably large exposure. So to that extent, those headwinds in our view are already there in the price that we see today at about 11,000 odd rupees. Stock is already off 30-40% from the highs. So to that extent, the valuations are discounting these headwinds in our view.
Could it happen that some of these headwinds don't quite firm up, and therefore there could be both a sentiment change as well as a multiple pickup as well in Dixon, Amber, or anything else? And you know, just adding to that, what would therefore be your pecking order within this space? Because now it's a very large bucket with large cap, mid cap, and small cap stocks all being there.
Right. So yes, valuations from the bottom for EMS companies after the results over the last couple of weeks, we have seen valuations moving up by almost 20%. That also goes along with the change in the investment sentiment and improving global outlook there. But if we look from where we are incrementally, if the Dixon-Vivo JV approval goes through, then definitely today the big concern in terms of earnings downgrade risk which is there, that gets addressed, and clearly they have a much stronger visibility on the volume growth trajectory over the next 2 years in this segment. So valuations which have nosedive should definitely get some breather, and earning momentum also will see upgrades coming through. But also want to highlight the peak valuation multiple which the sector had seen last year. That in my view, the growth-driven valuation premium which the sector and the companies were trading at, I don't think so those 60-70 PERs are coming anytime soon, because investors are also today very much cognizant in terms of the earnings growth, risk to margins, as well as working capital and ROE quality. So valuation multiples have tapered off, but from the current level, definitely there is headroom for both earnings re-rating as well as valuation multiple. If you look at the segment and space, Dixon again would be relatively high beta name here. If the approval comes through in time, there would be a big upside. If not, then where we are seeing the stock has been there today. Kaynes, in our view, has been more of a steady performer. For them, the re-rating would hinge on reduction in the working capital and receivables in specific towards fourth quarter, which the management has guided on the aggressive note. So if that delivery happens, then we see a reasonable re-rating for the stock on cards there. And Syrma, I think, to that extent, has been a steady performer, so they should be able to hold on onto the space. So to that extent, risk-adjusted bets, if we see, then to us, Kaynes looks a better bet. But if we are willing to look at a slightly high beta play and the event plays out in the favor of Dixon, then on an absolute basis, Dixon could provide much better alpha.
Thank you so much for that, Renu, Baid, Pugalia. They're always a pleasure to speak with you and get clarity on the space that you track so closely.